Okay, on to part 2 for chapter 4. So one thing we're going to do in this chapter, and we'll do it in most of the remaining chapters throughout the semester, is that as we go through the chapter, we're going to look at a few ratios to help us get a sense of how well the company's doing. Ratios are just some fairly simple mathematical calculations that we'll do based on numbers on the financial statements, and we'll see how the company's stacking up. Two things that we're going to evaluate first are liquidity and solvency using a couple of ratios. And the way ratio analysis works is we're taking two numbers, sometimes more than two numbers, but at least two numbers, and we're doing some division. And what we're going to do is, why ratio analysis is useful and why it's so widely used is it makes it possible for us to compare one company to another company. Because if you're trying to compare company A to company B, unless they're pretty much the same size, when we start comparing numbers, the numbers directly off the financial statements, like company A had cost of goods sold of this, how does that compare to company B's cost of goods sold? Problem we run into when we start making those kinds of comparisons is that size matters when you look at absolute numbers. If company A is bigger than company B, their cost of goods sold is going to probably be bigger than company B's, even if company A is doing a pretty good job of controlling their cost of goods sold. So what we can do to get around that problem are to look at ratios rather than raw numbers. And what we do with ratio analysis is one number is being divided by another number or numbers. And when we do that, we take the size of the company out of the equation. We're looking at relative amounts of things rather than absolute amounts of things. And when we calculate ratios, some ratios, when we calculate them, we can look at the ratio all by itself and interpret it and get some good information out of it. But usually what we do to get better, more information, is we make some comparisons. And the two ways that we typically make comparisons with ratios is that we can do trend analysis. Trend analysis means we calculate a ratio for a company, and we calculate it for several points in time. So we calculate the ratio for 2018, 2019, and 2020. We see how it's changed, what the trend is. Is the trend getting better or worse? We can get a sense of where the company's headed. The second thing that we can do, and often we'll do both, you don't have to pick one or the other, is to do benchmarking. Benchmarking is where we calculate ratios for company A, we calculate them for company B, we compare the two, and we see how well they're doing relative to each other. And those can be very useful because if they operate in the same industry at the same period of time, they're both facing similar constraints, similar market conditions, we can get a sense of which company's management is doing a better job. So both comparisons are useful, and it's usually useful to do both of those kinds of comparisons. So the ratios we're going to look at in this chapter are going to relate to the balance sheet. And remember what the balance sheet tells us. The balance sheet tells us three basic things. Assets, how much a company owns. Liabilities, how much it owes to third parties. And equity, how much of the firm is left over for the stockholders. And if you think about what we talked about early on in the semester, companies can finance themselves one of two ways. They can either borrow money, which is a loan, or we can use equity to finance the business. Equity takes two forms. We can sell ownership in the company and issue stock and get cash that way. Another way we can finance the business through equity is through retained earnings. We make money, we reinvest the money in the business, we use that to finance the operations of the business. So either we use debt or we use equity. And what we're going to look at with these ratios, we're going to look at a firm's liquidity and solvency. And we'll look at liquidity first. So liquidity, what it is a measurement. We've used this term already once in this chapter, and we said it's a measurement of how close things are to cash. Another way to think about liquidity that's related is to say how good of a job can this company do paying its bills in the short run? Is it going to have trouble paying bills that are going to be due in 30 days or 60 days? And what this gets to is how much cash are they going to have? Because in order to pay your bills, you have to have cash. So these ratios get at how much cash are they likely to have in the near term. So first ratio we'll look at is the current ratio. Current ratio compares two things. We take the total current assets for the company, we divide by current liabilities. And if you think about what these are, remember the definitions of these two things. Current assets give us cash within a year. Current liabilities use cash within a year. So when we look at this ratio, we're looking at how much the company is going to have available to pay bills relative to what's going to be due. And all else equal, the bigger the ratio, the more liquid the company is. So the more current assets we have relative to current liabilities, the more liquid the company is. Second thing we can look at is solvency. Solvency is the same idea as liquidity, but the time horizon is different. Question we're asking here is how likely can the company be able to pay its bills over the next 30 days? Here we're looking at how likely is the company to be around 3 years from now. Long term, how likely are they to survive? And we'll look at one ratio here. We're going to look at some more ratios later in the semester, but the one we'll start out with first is debt to total assets. And what we're looking at here effectively is how much of the company is financed with debt, because remember, we can either use debt to finance a company or equity to finance a company. And the intuition here is all else equal, it's riskier to finance with debt than it is with equity. When you finance with debt, you're locking yourself into having to make loan payments in the future. You have to pay both interest and principal. With equity, generally speaking, you don't lock yourself into any future payments. So debt, therefore, is a riskier way to finance a business. So the more debt we have relative to our assets, that means we have more risk. More risk means we're less solvent. So bigger numbers here indicate more risk, higher chance of default, less solvency. That's not to say, though, that more debt is necessarily bad, because fundamental premise of finance is that with risk comes more potential for reward. So having more debt can also allow you to be more profitable and make more money for the shareholders. So it's not to say that debt is necessarily bad. It just makes it a riskier company. Okay, we can also use the income statement to do some ratios. And usually when you look at the income statement, what you're trying to do is get a sense of how profitable the company is. And we'll look at a couple of ratios related to profitability. So profitability analysis is just looking to see how much money is the company making. How good are they at taking shareholder money and turning that into some profits. And a bunch of ratios you can look at here. We'll just look at one for the time being, return on sales ratio. This is a very bottom line measurement of profitability. What we do here is we take the number at the bottom of the income statement, net income, divide by the number at the top of the income statement, net sales. And this gets expressed as a percentage. And what you're effectively calculating here is for every dollar you sell, how much do you get to keep? What's left over after all the expenses have been taken away? Okay, components of stockholders' equity. So stockholders' equity, take a look at Microsoft real quick. Stockholders' equity typically has a lot of stuff in it. Actually, Microsoft's is pretty clean, but they have common stock, retained earnings, and then accumulated other comprehensive loss. All we're going to concern ourselves with in this course are the first two, common stock, and paid-in capital goes along with common stock, and then retained earnings. We will not concern ourselves with comprehensive income or comprehensive loss. So contributed capital is a capital that's been contributed by the stockholders of the company. What we mean by contributed capital is common stock, paid-in capital, and then there's another kind of stock called preferred stock that Microsoft doesn't have, but some companies do. So those three things make up the paid-in capital: common stock, preferred stock, and paid-in capital. And then the other category is earned capital. This is money the company's earned. The company's elected to keep it rather than paid out to shareholders and kept within the company. Another way of saying retained earnings. And remember the way retained earnings works. We've seen this when we looked at the statement of stockholders' equity. If you take beginning retained earnings, add net income for the period, subtract dividends for the period, that's your retained earnings at the end of the period. So retained earnings is just a rolling total. All the income the company ever makes is added. All the dividends it ever pays is subtracted. What's left over is retained earnings. And finally, last thing we'll look at for some analysis is the statement of cash flows. So statement of cash flows we've just looked at superficially up to this point. We'll dive into it in a lot more detail. I think it's the first chapter we look at after the second exam. But statement of cash flow is very simply what it does. It just shows you where cash came from for a business and where cash went to for a business. So it's a good tool that we can use to assess a variety of things. One thing we can use it to do is to assess solvency. And we've already looked at solvency one way, which is to say how much debt do you have relative to your assets. Another way to think about the statement of cash flows is to look at how much cash is available to pay off debt. And a little review here of the statement of cash flow. So statements of cash flow show sources of cash, in other words, positive cash flow, cash coming in, uses of cash, negative numbers on the statement of cash flow, cash going out. And we put it in three categories. Mirrors the three things a business does. They operate, they invest, and they finance. So we split the cash flows up into those three categories. So to show you a real statement of cash flows for Microsoft, here's what one looks for a typical company. Operations are listed first. These are cash flows related to operations. If you see a positive number, represents positive cash flow. If you see a negative number, represents cash outflow. Financing represents, it shows us cash flows related to financing a business, since we can finance with either debt or equity. Cash inflows and outflows from debt and equity go in the financing section. We repaid some debt. That used up $4 billion of cash. We issued some common stock. That brought in $1.1 billion of cash. So negative numbers represent cash going out the door. Positive numbers represent cash coming in the door. Third section is investing. Usually investing is here and financing is here. I don't know why Microsoft did theirs this way. This isn't normal. It doesn't really matter, but they flip-flop the two from the way they normally are. And what we see in the investing section is cash flows related to long-term assets. When we buy long-term assets, additions to property and equipment, we use cash, so we see negative numbers. When we sell stuff, we sell investments, we have cash coming in, so we see positive numbers. So this thing gives you overall what's going on with Microsoft's cash. They began the year with $11,946,000,000 in cash. They ended the year with $11,356,000,000. So cash went down by $590 million. Why did it go down? Operations brought money in. Financing used up some cash. And investing used up some cash. So we get a sense of what's happening with Microsoft's cash during the year. Ratio that we can calculate that relates to the statement of cash flows, and this one's not actually a ratio, it's actually a number, is free cash flow. Free cash flow is just what the name sounds like. It's cash that the company has left over, and it gives the company flexibility to do things. If you have free cash flow, you can do R&D, develop new products. If you have free cash flow, you can acquire other companies. If you have free cash flow, you can do R&D. You can launch a marketing campaign. It allows you to do things that you might want your business to do. So with free cash flow, bigger is better. The more free cash flow we have, the better. The way we calculate it is we take cash flow from operations. This is the first subtotal you'll see on the statement of cash flows. And then we subtract a number that you will find in the investing section, capital expenditures. And a little bit tricky here because companies don't always call this, the line item is not always called capital expenditures, but I'll show you how to find it here for Microsoft. And the way Microsoft does it is pretty typical. So the way we do free cash flow is we find how much cash came in from operations. That's the first subtotal. If we're doing this for Microsoft for 2019, $52,185,000,000. We would subtract our capital expenditures, and if you look in the investing section, you do not see capital expenditures listed. However, what capital expenditures, what that term means is how much did the company spend buying property and equipment. And if you look here, the very first line, additions to property and equipment, $13,925. That's capital expenditures for Microsoft. So if we were calculating free cash flow for Microsoft, we would say 52,185 minus 13,925. And one thing to note here, when you subtract the 13,925, ignore the fact that it's presented as a negative number here. Just subtract 13,925, because if you subtract a negative 13,925, you're adding it, which isn't what we're trying to do. So we'd end up with 38 billion-ish dollars of free cash flow if we calculated this for Microsoft. So Microsoft has a lot of cash left over at the end of the year. Okay, on the chapter, one last multiple choice question. Which of the following involves analysis of the income statement? 4 choices we will discuss next time we meet. Okay, if you got any questions about any of this, let me know, and we will talk about this stuff later.